Hello everyone, and welcome to the presentation for the SBI Corporate Bond Fund. As you are aware, this is an open-ended fund where the NFO opens on 16th of Jan. Before we go into the broad market dynamics, I would want to take you through the broad portfolio objectives and the portfolio positioning. This particular product comes within the, it's going to be a high quality medium-term product. As far as regulatory mandate goes, the portfolio needs to invest at least 80% of its total corpus in securities which are rated AA+ and above, as this is a regulatory prescription for this particular product category. As regards the portfolio positioning, the product would be invested 100% in AAA or sovereign securities. In terms of its duration positioning, as I mentioned earlier, the portfolio would be investing in the medium-term category with a portfolio maturity not to exceed 5 years. As regards the allocation and the strategy of the portfolio would have a core allocation to high-quality corporate bonds. At the same time, there would be exposure on a tactical basis to longer-term securities, to the extent that the overall average portfolio maturity is maintained within the cap of 5 years. As regards the category of investors who would be interested in such a product, this portfolio is primarily aimed at investors who would want to build a core portfolio in the debt category with an investment tenor of a medium to long-term investment tenor. Investors who are looking at high credit quality portfolio with a moderate allocation to duration would find this product suitable for their investing. And finally, we would want this portfolio to be considered as an alternative to the traditional fixed income avenues that we are more familiar with. Now let's move to the current bond market environment. As we are aware, the broad inflation trajectory has been fairly benign. We have seen inflation prints being materially lower than the RBI's 4% inflation target. The second variable, which is equally important in terms of market dynamics, is the incipient concerns that are emerging on global growth momentum. And to the extent that the growth momentum globally is weakening at the margin, it would influence monetary policy stance of major central banks, and it would have its own impact in terms of portfolio flows into India. As regards the RBI's stance over the last few policy statements, what has really stood out is one, in terms of projected inflation. It's well in comfort in terms of the projected numbers being lower than the RBI's medium-term target. The big significant change for the market has been RBI's liquidity stance. We have witnessed that the RBI has been proactive in infusing liquidity into the market by buying bonds through its open market operations. And in the current financial year so far, the RBI has done almost 2 trillion rupees worth of OMO purchases. The other important variable that has changed over the last few months has been the stability in the external sector accounts. We have seen a significant drop in international crude oil prices by almost 40% in the last quarter, and that has had a significant positive impact on expectations of India's current account deficit and the eventual balance of payment position. In terms of concerns, yes, fiscal dynamics look to be slightly weak, and that is getting reflected in the revenue collections, especially on the GST front. And finally, the other event risk that the markets would need to grapple with would be the political dynamics with the upcoming general elections. So considering the overall framework in terms of changed market dynamics impacting Indian fixed income markets, and some of the event related risk which I mentioned, apart from of course the credit related concerns that have emerged in the market over the last couple of quarters, I would say that investors do have bias towards maintaining investment in products with a high credit quality portfolio. And given the fact that market dynamics have changed at the margin in a positive manner, we would say that investors would need to have a moderate duration allocation in their portfolio. And this particular product broadly fits in the requirements considering the changed market dynamics that I mentioned earlier. Now, getting specific to the corporate bond spreads, we've seen that especially at the AAA credit spreads have stayed fairly elevated over the last few months. Of course, in the recent past, there has been some tightening at the margin, but when you compare with longer term history, especially since 2012, we are seeing that credit spreads, especially at the segment that we are talking about for this particular product, those are broadly at very elevated levels. Part of the reason is high corporate bonds supply, which has come in over the last few months. It's quite likely that you may see a larger amount of borrowing coming in through quasi-sovereign entities, which have actually significantly increased since the last couple of years. So a large supply schedule has kept corporate, especially the AAA corporate spreads, fairly elevated. And I believe that's an opportunity for investors, especially considering the current product positioning, whereas I mentioned earlier, the large part of the core portfolio would be invested in short-term AAA products. What we see is that even on the expectation of continuing PSU bond supply, as long as the broad environment has or the improvement in macro environment continues, or rather it favors an allocation to bonds, and with the RBI's slightly more aggressive liquidity infusion, we may see that credit spreads could gradually tighten over time. It may not happen in the very near term, but given the fact that the broad interest rate dynamics also could undergo a change over the coming year, we may see that over time credit spreads may tighten at the margin. But even otherwise, the pure accrual that is available from high quality credit spreads, especially the PSU segment, I think that's fairly attractive for investors to consider at this point in time. And to summarize, as I've mentioned in the earlier slides, AAA corporate spreads, especially among the public sector entities, offers a fairly attractive spread, especially for a short to medium term investment in the short to medium term segment of the credit curve. We have, of course, a large amount of comfort with regards to the expected inflation trajectory, which may influence the RBI's policy stance. And if very clearly, given the fact that inflation numbers are fairly comfortable, the RBI is likely to change its policy stance. And if some of these positive inflation outcomes sustain in the future, you may see a possibility of some reversal of monetary policy tightening, which the RBI has done so far. As we mentioned earlier, there are concerns with respect to trade war, especially, which can impact sentiments in the market. But broadly, global growth environment is likely to witness a slight moderation. Indian economy is largely insulated considering the relative growth differential that we seem to be having, but still any external market developments could have an impact on our markets. Finally, in the changed environment where the monetary policy stance could undergo a change, any positive market dynamics that arises from a change in the RBI stance, we believe can be captured more optimally through a portfolio that is moderately aggressive on duration, but at the same time focuses on a very high quality portfolio. And investors who have a moderate duration exposure, but at the same time are conscious of the credit risk within the portfolio, we believe this particular product will add a lot of value to their investment allocation. Finally, before we end, one needs to be cognizant of some of the risk that can impact bond market dynamics over the next few months. Event-related risks probably would rank right at the top because we are getting into a phase where general elections could be announced over the next maybe sometime in March, with elections due in May. So the outcome of the elections, if at all, if it is considered adverse, may impact market sentiments. Fiscal dynamics, which we mentioned earlier, those seem to be weak at this point. And in an environment where the government may be forced into some sort of competitive populist measures, I think at the margin fiscal dynamics would be very important to watch out for. Inflation trend, to the extent that it sustains the current trajectory, that's quite positive, but one needs to be conscious of any material change in some of those inflation dynamics. And finally, the risk sentiments in global markets. So we would continue to be impacted by risk on risk off flows, and that's I think an essential variable in our fixed income markets at this point in time. Thank you.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.